Hi, welcome back. This is the third video in the four-part series on analysing stocks, and we're going to talk about some positive indicators, what to look for in companies and what might make you want to buy into them. So the first of the three main factors we're going to look at is return on assets. The second is stable earnings, and the third is a stable dividend payment stream. So we'll start off with the return on assets. So this is recalling from an earlier presentation. We looked at a balance sheet. So you see on the left-hand side you have the assets, and on the right-hand side liabilities. And we're just focusing on the assets. So in this case, we had this Amsterdam bicycle company, a fictitious company that had 200,000 euros worth of assets, which were bicycles and spare wheels. So we're looking at how this company makes a return on just those assets, the total assets, in this case of say 200,000 euros. So the formula to work out the return on assets is quite simple. It's the profit of the company after everything, after tax, after all expenses, the profit, divided by the total assets, as we just saw in the case of this bicycle company, 200,000 euros. So you'd be dividing the profit by that 200,000. So what it tells you, and why it's an important measurement, is really how effective the business is at using the actual capital or the assets that it has. And it's simple, how much profit can they generate from $1 worth of assets? How effective are they at using the assets, the money that you as a shareholder or bank will give them? And to use a very simple example, say this bike company, if each bicycle that they buy costs them 100 euros and they rent them out, and after all costs, after all expenses, every year they make 10 euros per bicycle, then that's a return on assets of 10%. It's being 10 euros in profit divided by the 100 euros it costs them to buy this bicycle. So the other thing that it is important in showing is how a company compares with others and how well it can use the assets that it has to generate a profit. So what's a good return on assets? Because you need to be able to compare. Well, the long-term average is around 4%, and it really depends though on the industry. So you have to really focus on comparing within the industry. So very heavy-duty things where you have a lot of assets, things like mining is relatively low. Healthcare can also be very asset-intensive. You need to buy expensive equipment for hospitals, etc. So that's also quite low. Transportation is medium, and retail, as you can see, is a bit higher, 9% less intensive, and technology is usually around the highest, and that's around 10%, and that's because you don't need that much to make profit. The actual amount of money to go into the business is relatively slim. So let's see an example of return on assets and how businesses and strategy can tell you, and the return on assets can tell you how healthy the business is and maybe how it's going to go in future. So this is Microsoft versus IBM, and it's an interesting test case between two massive businesses in the technology space. And you can see, well, Microsoft has had a very high return on assets. It's currently 16%, and it was as high in the mid-20s back in 2008. It did come down and it started to rise up again. And IBM was very high, well, not quite as high as Microsoft, but still pretty high, near to 15% in the height of 2012, and then it's come down. So what's happened, and what does it tell you about the businesses? Well, Microsoft has moved from hardware, or doing really any hardware, to really focusing on cloud computing. So there's barely any assets required to be doing all this cloud software, and so they really focus on the software side where you don't need many assets but you get high profits. IBM, on the other hand, have until really recently missed that boat. They haven't focused on the cloud. So while you can see this uptick in Microsoft since they really started focusing on cloud computing and this software very asset light, you don't need to invest much money into it, IBM hasn't done that as much. So that's why IBM now is at 6% return on assets and Microsoft is 16%. And as you can imagine, as a shareholder, you've done much better holding onto Microsoft than you have onto IBM. And that's evident in these charts. So the next indicator we're going to look at is stable earnings. So the market, above all, at least for now, is interested in earnings, and it's moving more and more towards purpose and impact, but on the whole, it's interested in earnings. So when you're investing in a business, you want to see and believe that they can continue to keep earning money, at least not earn less, hopefully keep on increasing in the long term what they're earning, and it shows that they're delivering some sort of good product or good service to people, to consumers. So you want to look for a company that has had a general 5-year uptrend in earnings. It doesn't have to be each year's going up, but that there's a trajectory that's going upwards. They're improving in some capacity. It's sustainable earnings, it's not massive fluctuations, and it's not at the expense of revenue, so they haven't just cut costs to increase their earnings, because it's not a very healthy thing to do. And you want to look at the earnings per share, meaning it's how much each shareholder has of earnings, because the company can go and issue many more shares to grow, but each shareholder actually is receiving less of those earnings. So let's see an example of stable earnings, and that bodes quite well. So SAP is a big software provider from Germany, and you can see here from 2010 to 2019 their earnings per share, and they've done very well. I mean, it's an upward trajectory. It hasn't been up every year, but between 2010 they were around 150, and in 2019 around 275. So as a shareholder, you'd be quite happy. You've been rewarded by holding on to a company that's done well, and you could expect that as long as the service stays around, they should be able to continue stable earnings, at least. Obviously anything can happen. The next thing is stable dividends, and that's really showing the health of the company, because they've been able to pay out consistently, so their earnings that they're making they're not desperately making them. They have enough comfort that they're actually paying them out to shareholders and not just retaining them. And sometimes, as we looked in the past, it can be good to retain, but this is a way of seeing how healthy a company is. And the other advantage is that investors will pay a heavy premium or high premium for steady dividends, because a lot of people want to invest in a company just so they can get this dividend yield that we talked about in the last video. So if they have a very consistent track record of paying dividends, there'll be a premium. People will keep willing to buy into this company. The other thing to remember, as I said before, is not all companies pay dividends, so this isn't always a great indicator for you as an investor. And an example of a company that does pay steady dividends is SAP again. So you can see they've gone up each year, they keep paying out more, and it shows that the company believes that they're in a stable enough position to keep on paying out more and more, and they're confident in their business. And as a shareholder, if you're receiving these shares from them, these dividends from them, you're doing well, you're receiving some sort of return. So those are 3 positive indicators for companies. I hope you've enjoyed watching the video, and I look forward to seeing you in the next one.